Hello, everyone. Welcome back. Today, I want to talk to you about DXC Technology, a Fortune 500 company with over 100,000 employees. As my name suggests, Turnaround MD, I'm always focused on turnarounds because I think they offer very asymmetric risk reward for an investor who knows their way around and can really see the situation for what it is. So first, I want to give you my disclaimer. I'm not a financial advisor. This is not financial advice. Please do your own research. Don't just take advice from a guy on YouTube with a PowerPoint. With that out of the way, let's jump into it. So DXC was formed back in 2017 with the merger of Computer Science Corporation Exchanging and EDS. These three companies were pretty big in their own right, and the thinking by management was that they'd be able to create an organization with a lot of synergies and basically come in and cut costs. They regarded these three businesses as sort of declining marginal businesses with not a lot of future because the industry that they're in is IT services, something that has experienced a lot of difficulties with the emergence of the public cloud. And actually, you could see this throughout the industry. There's another company I look at called Kyndryl, which was the IBM Infrastructure Services spinoff that recently took place. There's another one called Unisys. So many of the problems that DXC has suffered from are really industry-wide and sort of a trend that you could see, almost similar to the oil industry back in 2020 when prices went negative. Much of the pricing just got very competitive. Companies responded by cutting costs, and when you can't cut costs any further, it really just eats into profits, and there's not really much you could do about it. So that's part of what happened here. Of course, there's more to the story than just that. So let me just talk a little bit about the business first. So DXC operates in two principal businesses, Global Business Services and Global Infrastructure Services. Global Business Services is actually fine. It's analytics and engineering, almost what some of the really trendy names out there do, Palantir, stuff like that, EPAM's another one. This is really just looking at all the data that an organization generates, coming out with some interesting ways of looking at that data and really, analyzing it and driving further cost efficiencies. There's also applications. This is really custom applications. An interesting example of this is I think the Italian healthcare service is contracting with GBS to create a app on your phone that will allow you to interface with the health insurance program for that country. So that's custom apps. Then there's insurance software and BPS, business processing services. This is basically software that was created mostly by Computer Science Corporation back even as far back as the 70s. That is still used by many insurance companies and even banks because the software is just custom made for those organizations and very, very challenging for the entities to move off of. So this business really has a very strong moat, and the customers are actually almost captive. There's obviously modern software as well that the insurance software business and BPS businesses are building, but that's sort of the legacy. So many of those customers are just stuck. So, very sticky business for them. Maybe customers aren't quite as enthusiastic about having that relationship, but there's really nothing they could do about it. So that's basically the kind of growth stuff for GBS out of the way. Next, we'll talk about GIS, Global Infrastructure Services. So this is really sort of the stuff that's gotten beat up by the cloud. We have obviously security, which this is just everything from networking and implementing security solutions that really have to deal with the infrastructure of a customer's IT organization. Not the biggest business for them, but I actually think that this business can grow pretty well. And it really hasn't seen quite as much revenue erosion as the other businesses. The next one is cloud infrastructure and ITO, which this business obviously has been kind of a mixed bag, because on one hand, you're moving customers to the cloud and you're getting some revenue off of that, but at the same time, many of their IT infrastructure components that you're moving to the cloud, those were actually completely managed by GIS. So that creates a lot of headwinds. The ITO component of this is really just if an organization has an IT department and they want to completely outsource it, they could do that by contracting with the GIS business. Then there's Modern Workplace, which this is basically supporting at-home infrastructure. So, how do you get an employee to move their workplace from the business's headquarters to their home office, and making sure that it's secure and interfaces with the rest of the organization's IT. Okay, so unsurprisingly, DXC has been fraught with a lot of issues. You could see the stock is down 75% since its peak, and revenue has fallen from 21 billion to 14 billion. Some of this was the aforementioned problems that they were having with cloud, just general market dynamics. But also, the cost cutting that I mentioned earlier was way too aggressive. A lot of customers had service disruptions, and they ultimately decided that they were no longer going to stick with DXC and went to DXC's competitors. So that's, I would almost say that that's probably a bigger component as to why the revenue has declined, other than just the general market dynamics. So why am I enthusiastic about this business? Why do I think that this is a good business, now that you sort of have the context of why they're struggling and what's going on? So first, I want to say, if we look at the last 4 quarters for DXC and adjust it for various businesses that they've sold, and also just take currency out of the equation, because euros fluctuate against dollars and it could really kind of mess with the revenue statistic. If we kind of just set that all to the side and adjust revenue, try to get more of a realistic idea of what's going on, we could see that for the last 4 quarters, DXC's revenue has actually been flat. This is obviously very important when a company like this has never in its history of operating grown revenue even once. To see them come in for the last 4 quarters and have flat revenue, that's really kind of an interesting sign. The revenue was down year over year, but also, management is guiding to revenue growth next year. So, in its totality, there's a lot of interesting things happening on the revenue front. Could also see when we look at the book-to-bill for GBS and GIS in the most recent quarter, most of the businesses are actually booking more contracts than they're losing. So, obviously book-to-bill, this measures new contracts booked divided by contracts billed to the customer and work completed. So, if you have a book-to-bill ratio of over 1%, then the company is obviously booking more than they're billing. And that's what this shows here. Across the whole businesses, they're basically replacing everything and have a book-to-bill ratio of 1.04. And then in the GBS business in particular, there's some interesting things happening around the analytics and engineering front that really show that there's a lot of demand for those types of services. And one of the interesting things is, a customer may come in on GIS, it may be a legacy customer, very large corporation, and DXC can kind of transition them through up the value stack into that analytics and engineering component and really, leverage their historical relationships and sort of get them into this new business. Another thing that I think is pretty interesting, which is encouraging for GIS in particular, is we're starting to see a little bit of a cloud blowback. There was a few notable articles we're in talking about organizations leaving the cloud and migrating back to on-prem. This is encouraging for DXC, obviously, because one, they run the on-premise solutions, but two, you actually have to sort of integrate all your various IT services and offerings back to an on-premise model. There's also a hybrid model that a lot of companies are opting to do, and clearly, if you have an IT infrastructure in both the cloud and on-prem, there's a lot of work that needs to be done to ensure seamless integration between the two. Furthermore, you have things like electric grids, telecommunications, hospitals, even like restaurants. When you go to McDonald's, there's a lot of IT services that are on-prem there. And the reason for this is you want to avoid latency. So when I go to McDonald's and I order, I don't want to have a delay between when the order is input by the cashier and when the cooks in the back start making my food. You want that to be immediate, and to do so you have to have on-premise IT. And so that also presents a big opportunity for DXC because it may seem innocuous in the case of hospitality, but if we're looking at an electric grid, it can literally be the difference between life and death when people lose power. And so there's a lot of redundancy that's put into that, and just overall a ton of IT work that is needed to ensure that that is going to be safe, reliable, and bulletproof. These applications are really known as mission critical, and this has been a big focus of DXC in the last 3 or 4 years. So actually, DXC's margins are starting to expand all while their revenue is flatlining, which is kind of an interesting trend because, if we think that revenue is going to go from flatlining to growing, which is what the management team is guiding to, then obviously having higher margins would almost seem counteractive to that. But one of the big focuses of the management team, the new management team, has been to close data centers that aren't at full capacity, and also change the pricing model for many of these contracts and pass on things that just aren't profitable. They've really put an effort into enforcing COLA clauses, no longer doing revenue that is just passed through and not really accretive to their margins, and really getting into the details of the contracts and driving them through. There's also been various restructurings within the organization as well, and this has led to software people selling software, as you would expect, and services people selling services. That was not the case under the old management team. Much of the various parts of the business were kind of mixed together, and then expenses were cut without much regard to this. The new management team under Mike Salvino, who actually came from Accenture and has a lot of experience in this business, has really been very focused on driving through the business and getting into the details, and no longer having the wrong people selling the wrong products. So the next thing I want to talk about is DXC's free cash flow. I made it this far in the video. I haven't mentioned this yet, but DXC's market cap is only $5 billion. And they're doing about $700 million in free cash flow annually, with a guide to $900 million in free cash flow next year. So that's obviously really attractive because they're doing more than 10% of the company's value in free cash flow alone. One thing that makes this a little bit more complicated is DXC does utilize capital leases, which are a use of cash. And I suspect that this is why the market cap probably doesn't give much credence to the free cash flow number, because much of the free cash flow is just used to pay off the leases that they've generated. But the management is aware of this, and they have a plan to basically do away with the capital leases and buy the remainder of the equipment outright. This will put a little bit of headwinds in the CapEx in the short term and make the free cash flow number look lower than it actually should be. But long term, they're going to own that equipment and they won't have to keep making lease payments for stuff that they already own. So the free cash flow number will be accurate. It's just a matter of working off these capital leases. So you should see a big expansion in free cash flow after you adjust for the uses of cash going forward. So to end this one, I just want to go over a quick comparative analysis between WePro and DXC technology. Obviously this should not replace your fundamental analysis. Still do your DCF, still look into the details, check the multiples, look around, really get an understanding of just how cheap DXC technology is. But what this will show you is the different attitude that the market has towards WePro versus DXC technology. WePro and DXC are basically the same business. There are some minor differences between the two. WePro obviously is an Indian IT service company versus DXC Technology, which is based in the US. But they are peers, and I think that there's a useful analysis that can be made between the two. WePro does about 11 billion in revenue versus DXC's 14 billion. EBIT margin for WePro is way higher, 20% versus 6.8% for DXC. And obviously WePro is growing revenue while DXC is not. There's no reason why DXC cannot become what WePro is. EBIT margin can expand. They have the right management to do that. They have the right strategy. Revenue, as I've shown, is beginning to flatline, and I think probably next year or the year after it will grow by roughly 1%. WePro, as I recall, grows by 8%, so still a long way to go, but I think we could, over the course of a few years, get in that ballpark range. So let's look at the market cap of WePro now. It's 25 billion. DXC is only $5 billion. So that is a considerable discount for a corporation that can become what WePro can become. And as I think you see DXC continue to execute against their strategy and move into that sort of field, you're going to see the market cap difference narrow between the two. This doesn't even mention the fact that DXC has repurchased over the last year 18% of the outstanding float and will repurchase about another 20% of their stock. This is incredible for a company that is just really depressed and the valuation is really low. You aren't going to see that make a big difference in the stock price tomorrow. Might not even happen this year. But this stuff is cumulative. And as the company improves, you're going to see the effect of the share repurchase basically all at once. And it's going to be a pretty big bump to the company's valuation. And also, I just want to mention, as you're doing your own research, you're going to see a very, very pessimistic market attitude because DXC has done so poorly for so long and they haven't had the right people in place. But this is why this opportunity exists to begin with. I think an argument can be made, whether or not it's true is one thing, but the argument can be made that this is a 10x opportunity. If you see the free cash flow get up to $4 billion, maybe in five or so years, I don't think a $50 billion valuation is crazy here. As crazy as it may seem, the profitability of this thing is going in the right direction and a considerable amount of progress is being made very fast. There are also complaints and what I would call FUD launched at the management team. In my view, the management team is fantastic. They've done all the right things, and when you look at the mess that they inherited from the old management team, it's just a completely different business, and they're in much, much better shape. It takes a while to execute on a turnaround. I've seen this in the other turnarounds that I followed. Many times it takes 4 years, 5 years, maybe even longer. But what I can see from this situation is DXC is improving, and I'm confident that if you look at this with nuance and rational thought, you will be able to see the same thing. I have yet to see a compelling bear thesis here that really goes beyond, well, the revenue is declining, well, the management is overpaid, well, this or that. It just does not stand to reason. The revenue is going to grow. And when the revenue grows, you're going to see a complete re-rate in the stock because people don't think that this company can grow revenue, and that's simply not true. So I encourage you to do your own research, really think this through. You know, it is a contrarian play. Everybody hates this corporation, but they're wrong. So, you know, without further ado, thank you so much. Again, I want to reiterate that this is not financial advice. Please, please, please do your own research, think it through, and thank you. Thank you for listening.